Welcome everybody to the DMH Regional Economic Outlook, and we have a fantastic panel here with us today. I'm the chair of proceedings, and I'm just hoping, as you can imagine, that there are no deliveries and I'm not attacked by any pets or dogs or anything else. I'm a specialist in domestic and international commercial litigation, including banking and finance, regulatory and antitrust competition practice. I have qualifications as a solicitor, barrister and commercial arbitrator. At this point, I'm going to hand over to Victoria Kerton, who's Regional Director at Commercial Banking NatWest, with 20 years, more than 20 years, market experience supporting UK management teams, raising growth capital and acquisition finance, originating, structuring, and executing debt mandates across the full institutional, corporate, and commercial franchise. She specializes in the mid-market, SME commercial segments, and family businesses. Victoria, without further ado, I'm going to hand over to you.
Johnny, thank you so much, and good morning to everyone. Really delighted to be here joining my colleagues from DMH Stallard. So I thought I'd use the next 10 minutes or so to update on economic outlook and forecasts, outline some of the key announcements in the March budget that are relevant for business owners, and touch on some key aspects which can help position your business for recovery and for growth. I'll be happy to take any questions at the end, so please use the Q&A functionality on Zoom to help here. And I also have a few slides today which I will speak to, and these will be available afterwards should you wish to have a copy. So on to my first slide, which is always my favourite, as it captures scientific, economic, financial and societal measures of our outlook and performance. What does it tell us? In a nutshell, the outlook is cautiously optimistic. Starting at the top, whilst GDP continued to fall in January following a full year contraction through 2020 of 9.9%, the fall in January was constrained. At 2.9%, this was less than expected, and it was also supported by improving views of business confidence. Review of high-frequency data points, such as payments data, chats data, cards data, footfall and mobility across all of the quarter, has painted a picture of a bottomed out low point in February and improving activity into March, with even retail sales across food and non-food items recording growth. Furthermore, business surveys through February also guide to the beginning of the retreat of COVID uncertainty. And whilst the number of the workforce on furlough remained high at 19%, we are seeing a more stabilised proportion of the furloughed workforce, around 15% for the next few months ahead. But challenges still remain, and they're not consistently spread across sector or industry. Next slide, please, Amber. So through the first quarter, consumer-facing services and education have been hardest hit through lockdown. The fall in performance in the consumer sector is also unlikely to fully recover, as some operators were just hit too hard. Add in other compounding effects of structural shifts in buying patterns, digitisation, different supply chain logistics. This means the outlook for some consumer sectors could remain vulnerable even as we move out of lockdown. But the lockdown exit roadmap is in place, and as of this week, it is firmly underway. And additional fiscal stimulus announced in the budget of almost 3% of GDP gives real confidence to the occurrence of a more robust recovery, likely to be firmly underway in real terms from April onwards. Following 2 months of decline, the March UK composite PMI survey rose strongly to 56.6. For PMI surveys, any measure over 50 is a sign of growth. And this is even more impressive given lockdown restrictions do remain in place. And there has been a real evidence of a spring surge in demand. Both services and manufacturing posted strong rates of growth in output, orders, and increased staffing levels. OBR forecasts reviewed in March now anticipate approximately 4% growth in GDP for 2021. This is also forecasted to rise to 7.3% growth for 2022. And NatWest views are slightly more optimistic with levels of 5% and 8% respectively. Amber, next slide, please. Thank you. The labour market remains in what we call suspended animation, thanks to the effectiveness of the furlough scheme. Unemployment is now unlikely to rise until later in the year, post-furlough. But what is most interesting is that the OBR's latest peak estimates have been reduced, and unemployment is not expected to reach more than 6.5% at the end of the year. So turning to the March budget. Amber, next slide, please. And moving on. Next one, please. Sorry, Amber. Thank you. So a recovery-focused 2021 budget. The headlines. Rishi Sunak unveiled a significantly larger than expected fiscal stimulus. £59 billion of additional policy easing in the 21-22 fiscal year was announced to support the economy through what is hopefully the pandemic endgame. These measures include a range of things: an extension of the furlough scheme, income support for the self-employed, business grants, 3-month business rates holiday, VAT cut extensions for the hospitality sector, and a 6-month universal credit extension. With most of these measures extended to September and the government's goal of removing most pandemic-related restrictions by June, many businesses may take solace in additional near-term support. Next slide, please, Amber. So some of these measures include the likes of the temporary super deduction, which is of up to 130% tax allowance made available to encourage investment in new plant and machinery, which could help get domestic manufacturers spending. So I'd like to put this super deduction into a practical context. What exactly is it and how can it be utilised? For a period of 2 years, from April 21, companies will be able to claim a super deduction on any qualifying expenditure, which in many cases will enable an allowance of 130% on most new plant and machinery investments for tax purposes, and these which would ordinarily have only qualified for an 18% allowance. In other cases, there will be allowances of up to 50%, where ordinarily a 6% special write-down allowance was in place. So what plant and machinery is included? Well, the list is wide. Qualifying assets include, but are not limited to, solar panels, computer equipment and servers, office chairs, office desks, tractors, lorries, vans, ladders, drills, electric vehicle charge points, refrigeration units, and more. This super deduction has most definitely been introduced to stimulate business investment and CapEx, and to address our UK productivity gap against peers due to historically low levels of this investment compared with other nations. How can it help you? Well, in order to qualify for the 130% super deduction, 3 metrics must be met. The asset must be a main rate asset, the asset must be bought new, and new disposal rules must be followed. But the tax effect can be considerable. So for the purpose of easy calculations, an investment of, say, £10 million on qualifying assets can increase tax savings from just under £500,000 to just under £2.5 million for a relevant business. So we have bigger fiscal, pay now, tax later, and this brings broad near-term business support. But there's no such thing as a free lunch, and taxes will rise and they will remain a risk. Most of them are backloaded tax increases from 2023 onwards. And they do fall mainly on the corporate sector, but a sizable proportion will also hit households, mainly through freezes to thresholds and allowances. The fiscal deficit is also projected to balloon to just over 10% of GDP. And the projected deficit reduction reflects a combination of broadly stable tax receipts and significantly reduced public spending. Next slide, please, Amber. Thank you. So what does this mean for your business? There is funding support available and a wide range of grants and access to schemes should you require additional support beyond conventional levels. The key government lending schemes stood up in 2020, known as CBILS and the Bounce Back Loan Scheme, closed tomorrow for applications. And these have provided tremendous support for many UK businesses. Over £75 billion of funding has been extended under these loan schemes, supporting over 1.6 million SMEs. And by many accounts, this has shored up liquidity and cash flow, now enabling businesses to move from survival to recovery focus. On the 6th of April, the Recovery Loan Scheme will be launched, giving business the opportunity to secure additional recovery funding, albeit this scheme will have some key differences to the Bounce Back Loan Scheme and CBILS schemes, and require bank appetite approval and will come with fees and costs associated. However, this will stand alongside active lenders and capital providers in the market, as well as strong investment incentives for CapEx and R&D via tax treatment, incentives for recruitment via apprenticeship grants and employment support, together with other protections on premises, landlord actions, and winding up petitions. So all in all, even though we are still living under COVID restrictions, we have definite signs the economy is reviving. Confidence is bolstered, uncertainty is retreating, and we have a supportive business environment seeking to provide incentives and protections for business as they navigate their own recovery. Not least, ambitious but accelerating plans across the public and private sector to really go after measures that drive green investment and deliver sustainability as we all face the other crisis, climate change. But again, this is being led by positive action and the programme of incentives for businesses and households to participate. So cautious, but very real optimism for business for 2021. Thank you. I'd be delighted to take any questions.
Victoria, we do have some anonymised questions which have come in. Well, they're not anonymised, but for the purposes of this discussion, all questions that come in will be anonymised. The first one, we have two that have come in so far. Where do you see inflation in the next 12 months, given the US, UK, and EU recovery measures?
Oh. Well, inflation, there was a fairly consistent view with regard to inflationary expectations last year. However, over the course of the last few months, there have been announcements of huge fiscal stimulus packages in the US. There have been pressures on supply chains as a result of Brexit. There's been elements that we've recognised of cost price inflation coming through and a steepening of a yield curve. What does all that mean? It means that there is no consistent view as to what inflation is going to look like over the next couple of years. The economists and the statisticians refer to a doubling of the size of the confidence intervals that they can now apply to inflationary expectations. It will be a key focus, and it is something that is spoken to, and policies will be definitely there to support. But it is, we've got monetary policy looking to support this. It is real, but it will be very carefully managed.
You're on mute. It seems to be the chorus of the last 12 months, doesn't it? So the second question, and we do have a third that's come in. Do you see interest rates rising in 2021 or 2022? And if so, to what level?
So again, this will be something of very real concern, both in address of any kind of inflationary pressures that we feel in the UK, but also the way that we manage what is a very large debt pile, not just of all the businesses that have borrowed under the various government lending schemes, but the government itself and the huge amount of public spending that they have invoked through this pandemic. So there's a real motivation to from the Bank of England to keep interest rates under a certain amount of control. There is expected, our group economists anticipate a rise of 25 basis points towards the back end of next year. The general consensus is lower for longer. And there are still quite a number of different tools that the Bank of England and other central banks can utilise to help support and manage the interest rate environment and the inflationary expectations. But lower for longer and quite possibly a small uplift next year. The threat of negative rates still exists, but it is retreating.
The questions are now coming in quite thick and fast. I think we've got time for two more for you. One is from a commercial property specialist, manager. So what pressures do you see on commercial property, whether office or retail based? Are lenders increasingly discounting them as security against lending?
So I've just had a real estate specialist join my management team, which has been fabulously insightful actually as to some of the forward-looking dynamics that owners of both commercial property and industrial property have and the way that they are preparing for activity. Not commercial property per se, but industrial, we're definitely seeing huge sparks of life and activity across the industrial sites, because we're seeing, for example, local Chinese restaurants moving away from a high street and moving on to an industrial park and using commercial kitchens to help support their activity. We're seeing movement of retailers, again, away from the shopping centres and the high streets, but into the bigger parks. So industrial commercial property is definitely seeing huge uplift. Commercial property in the sense of offices and where people are located. Almost every business that we speak to is looking at ways that they can trim their footprint. And this clearly has consequences for the owners of those office spaces. But the biggest thing influencing the commercial property sector is actually not about the supply and demand, which is, it ebbs and flows, but it's not falling off a cliff by any means. The biggest thing influencing the commercial property sector is the sustainability and the environmental credentials. And these are things that I would urge all business owners to take seriously and to build into their business planning and risk considerations. So we will increasingly have tighter restrictions on lending appetite for premises which do not meet minimum energy efficiency levels. There will be a combination of positive and punitive actions for commercial properties should they not meet minimum energy credentials. And I would suggest actually it's the sustainability and the environmental risks that have the greatest influence for offices as well as other forms of commercial premises over the next few years.
And as they say on any questions or question times, got time for one more, I think, and I must ask you to be brief. I'm afraid. Do you have any insight. I think this question is largely asking you to expand upon your answer on interest rates and project into the next 5 years. Do you have any insight into what NatWest may be planning for interest rates over the next 5 years? Presumably they will need to rise at some point.
Yes, and there are expected gradual increases stepped up over the course of the next 2, 3, 4 years, but they're absolutely sort of kept to very gradual steps. So the forecast is rising rates, but rising rates to still stay lower for longer. So as I mentioned before, not really anticipating movement until the back end of next year. However, things change, but it's slow but steady.
And now I'm going to move on to Oliver. Oliver Jackson, who has recently joined us, and Oliver is head of our insolvency and restructuring at DMH Stallard. But what I would say to everybody on the floor, all the participants, is this: if you do have any more questions for Victoria, just pop them down using the chat function and I will see if I can get to them at the end. Oliver recently joined the firm, having previously been a partner at Anthony Gold in London, and before that at Mondays, indeed, in Surrey. Oliver is a particular specialist in insolvency litigation, acting for insolvency practitioners throughout the Southeast, and in relation to protection and indeed realization of assets for creditors. He also advises directors, individuals, security holders and investors on all aspects of insolvency, corporate recovery and instruction, and again, reconstruction, I should say. And again, there'll be questions for Ollie at the end. Ollie, I'm going to hand over to you now.
Yes, thanks very much, Jonathan, and thanks, Victoria. So I'm going to be looking at recent changes in insolvency law that may have relevance to businesses later this year as the economy gradually unlocks. I'll be focusing on the changes that have been made to the insolvency regime last year, brought about by the Corporate Insolvency and Governance Act 2020, known as CIGA 2020, which came into force in June last year. CIGA 2020 represented the biggest shake-up in English insolvency law for many years. It introduced some temporary measures intended to assist businesses during the pandemic, but also it introduced some permanent provisions, in particular two new insolvency processes, namely a new moratorium procedure and restructuring plans, which are now available to companies as an alternative to CVAs, i.e. voluntary arrangements, liquidation or administration. And at the end of this talk, I will just touch on also some recent changes that were made in the autumn to the rules governing the priority of Crown debts when companies become insolvent. So it's quite useful to see CIGA 2020 in the context of the package of measures introduced by the government in the last year. And so I've summarised the main ones as I see them on the slide, but obviously to some extent this overlaps with what we've already heard from Victoria. And it's interesting that although, as Victoria said, output shrank by 9.9% in 2020, taking the economy back to its 2013 size, despite that, corporate insolvencies fell in 2020. The number of insolvencies last year were actually 27% lower than in 2019, which are actually the lowest for a decade, which just indicates the degree to which government measures have been holding up the economy. I think the view is that these measures have deferred rather than prevented the effects of the pandemic being reflected in corporate insolvency levels. As these support measures are lifted during the course of this year, then inevitably I think we will see insolvencies rise. So looking at the key temporary provisions of CIGA, well, the main one, the most visible one, has been the restrictions on winding up petitions. Specifically, you you cannot at the moment present a petition which relies on a statutory demand served during the relevant period, and that's a period that ran from April last year and is currently due to run until 30th of June this year. It was actually extended only last week. It was the relevant period was due to expire tomorrow, so businesses have been given another few months. In addition, no winding up order can be made which is based on a petition presented in the relevant period, unless the court can be persuaded that either COVID has had no effect on the fortunes of the company, or even if COVID had not had an effect on the company's finances, the company would have been insolvent in any event. This can be quite difficult to prove, and it has proven to be quite a high bar that has killed off most winding up petitions. In addition, there have been restrictions on temporary restrictions on bringing wrongful trading claims. These are claims where brought against directors when a company trades insolvent. Basically, the rule is that unless there is evidence to the contrary, the court will assume that directors are not to blame or responsible for any worsening of the company's financial position. There are also further temporary provisions providing for a relaxation of some of the rules governing the obtaining of one of these new moratoriums when a company is subject to a winding up petition. But I will come on to those when I talk about moratoriums. In fact, I'm going to talk about moratoriums now. So these are, as I say, a brand new feature of the insolvency landscape created by CIGA 2020, and they are a permanent feature now of the insolvency landscape. The main features of them is that they're designed to give companies a breathing space, temporary breathing space, and so they're likely to be of interest to companies or businesses suffering from short-term cash flow difficulty. It's an informal process. No application to the court is required, at least initially, and you can get a moratorium for an initial period of 20 days without requiring creditor consent, and that can be extended informally for up to 40 days. Extensions beyond 40 days will either require creditor consent or approval of the court following an application, and they can be extended by up to a year. The main requirement for a moratorium at the start is that you need the support of an insolvency practitioner who is willing to act as a monitor for the scheme, who will oversee it, and they must be able to make a statement that the moratorium is likely to result in the rescue of the company as a going concern. So the monitor will then give notice to creditors, and he will make appropriate filings at Companies House, and he will have to make a filing at court. For the duration of the moratorium, however, the directors will remain in day-to-day control of the running of the company, but the monitor will need to approve certain transactions. More about that in a minute. And it's expected that the moratorium will be used as a stepping stone for companies as they prepare to enter into a CVA or possibly an admin as well, administration that is. In terms of what it means for creditors when a company gets a moratorium, well, it gives the company a payment holiday for pre-moratorium debts. This payment holiday, however, does not apply to fees and expenses of the monitor, payment for goods and services supplied during the moratorium, rent during the moratorium, wages, salary and redundancy payments, and it does not apply to most types of financial services debts, so repayment of bank loans, for example. There will be, while the moratorium is in place, a prohibition on forfeiture, any sort of legal process, execution or other means of enforcement, and security cannot be enforced without the consent or permission of without the consent of the company or permission of the court, and there can be no repossession of hire purchase goods either, and floating charge holders cannot restrict the disposal of assets of the company or crystallize their charge. and suppliers must continue to supply the company unless the company agrees otherwise, or unless the supplier gets permission from the court to terminate their supply. They'd have to plead hardship. In terms of the restrictions of the company's activities, well, you need to, if the company intends to incur credit of £500 or more, they must inform the supplier or supplier of credit, provider of credit, that the moratorium is in force. The monitor must approve sales of assets outside of the normal course of the business's, the course of the company's business, and they must approve a grant of new security over the company's assets. And the company may not pay pre-moratorium debts, i.e. the debts that are subject to this payment holiday, unless either the amount paid to the creditor does not exceed either £5,000 or 1% of the liabilities of the company calculated at the start of the moratorium, whichever amount is the greater. Or alternatively, unless they can get the consent of the monitor to pay the debt, or unless payment is pursuant to a court order or has been court sanctioned. Other than that, the directors, they can still put the company into administration or liquidation, but they would need to notify the monitor first. In terms of the eligibility for a moratorium, well, it's available for all companies, except but not financial services companies. And it is available for even for some overseas companies, provided they have an establishment or operations here that are capable of being wound up here. Although in that case they would need to apply to the court for permission to go into a moratorium. And here are the two of the temporary restrictions that are currently in force. So from the 1st of October, if the company is subject to a winding up petition, it will need to apply to the court for a moratorium. At the moment, they don't need to. That rule has been relaxed. And in addition, from the 1st of October, a moratorium will not be available for companies who in the previous 12 months have been in a CVA administration or earlier moratorium. Again, that rule at the moment has been relaxed. And again, these were measures that were due to come in on the 1st of April, but they've been extended to October. So that's all I was going to say about the moratoriums. The other main new scheme that's a permanent feature of the insolvency landscape are the new restructuring plans. These will operate very much like existing schemes of arrangement, and they will encompass anything from a debt for equity swap or any other arrangement with creditors. They borrow elements of Chapter 11 in the US. There are three main stages to the approval process for a restructuring plan. First of all, with these, you do need to apply to the court for a court-ordered meeting of creditors and members. That's stage one. Step two, at the meeting of creditors and members, ideally, you need to have approval of 75% of each class of creditors and members. I say ideally because there is then step three. The company has to go back to the court for approval of the plan. The court can still approve the plan even if there are dissenting classes of creditors. The court can overrule one or more dissenting class of creditors or members. By dissenting, that's any class which doesn't reach the 75% threshold. However, the court has to be satisfied that there is at least one class of creditors or members on board with the plan, and the court must also be satisfied that none of the members of the dissenting class would be any worse off under the plan than they would be if the plan is not sanctioned. So that's all I was going to touch on restructuring plans. It's really just to mention that they're there as an option. And then the other main insolvency sort of new rule that's contained in CIGA 2020 concerns supply contracts. and this is that provided a supply of goods is paid for, suppliers can no longer stop supply of goods or services as a result of the company entering into a formal insolvency process, i.e. administration or a CVA. This means that any clause in a contract for the supply of goods and services entitling a supplier to automatically terminate the contract or the supply in the event of a company going into insolvency, that clause will be invalid. And this means that a supplier cannot demand payment in respect of pre-insolvency charges as a condition of continuing supply. There are, however, exceptions to this. The company or its liquidator or administrator can agree to terminate the supply contract. The suppliers equally can seek court permission to terminate. And again, they would need to prove hardship by having to carry on. And the rules do not apply where either the company or the supplier are involved in financial services. And in another temporary provision, until the 30th of June this year, the new rules will not apply to suppliers who are deemed to be small entities as defined under the Act. So that's all I was going to say on CIGA, Corporate Insolvency Act. Just touching on Crown Preference. So as I say, these rules came in the autumn. So this refers to the priority status given to certain debts owed to HMRC when a company enters a formal insolvency process. Specifically, in relation to insolvencies commencing on or after the 1st of December 2020, HMRC now ranks ahead of floating charges and unsecured creditors in relation to the following: PAYE, income tax, construction industry training deductions, employee national insurance contributions, student loan repayments, and VAT. The changes do not apply to taxes owed by the businesses themselves, such as corporation tax and employer national insurance contributions. In respect of these, HMRC continues to rank alongside other unsecured creditors. In terms of the impact of these changes, there's been much debate about the impact. It's expected to have a particular impact on lenders holding floating charges who rank behind preferential debts. Until now, this has not been an issue because of the previously extremely limited scope of limited scope of preferential creditors. And it's likely to reduce restructuring options for companies. CVAs are likely to be less attractive to unsecured creditors or holders of floating charges, as with more money going to HMRC, returns could be too low for other unsecured creditors to agree to the process. There's also a concern that if HMRC insists on payments in full, this may kill any planned CVA. It may also lead to lenders changing their lending practices, preferring fixed charges and reducing their exposure against floating charge assets where possible. They may require alternative security, for example, personal guarantees, financial collateral, i.e. holding a cash sum as security. And there may well be increased due diligence with lenders asking for evidence of accurate tax records, for example. So that really sort of all I was going to say on Crown Preference, and covers my topics. So yeah, any questions?
Well, it's odd, Ollie, that you should mention that, because we have actually got quite a few questions in for you. I'll ask you, obviously, because of time constraints, to be as succinct as you feel you're able to be. But the first one, again, anonymized, is what are likely to be the greatest challenges to creditors caused by CIGA 2020?
Well, I mean, I think certainly the restrictions on winding up petitions has been a cause of frustration for creditors, because the threat of winding up, either through serving a statutory demand on a company or winding up petition itself, and that's a well-used method of debt collection, as all sort of litigation lawyers will know. That has been quite frustrating not having that tool in our armoury. I mean, other than that, I think, well, the new moratorium procedure has created a much more debtor-friendly environment, which will be a challenge for creditors who are subject to the payment holiday and who find themselves unable to take enforcement action. I mean, along with the changes to Crown preference, moratoriums are another blow for holders of floating charges who are prevented from crystallising their charge or taking steps to protect their position. And then obviously, even within restructuring plans, you've got dissenting classes of creditors face the prospect of being overridden if the company's plan receives court approval. So those are the sorts of areas where I thought creditors will be facing a challenge.
And this one follows on from what Victoria was saying about the really the suspension of a lot of debts and parts of the economy, and that is this: can we expect a large increase in insolvencies as parts of the protections under the CGA 2020 start to fall away?
Well, I think as Victoria said, companies, even when the support measures start to be lifted, companies will still benefit from the loan schemes that are available. And I think bounce back loans they can provide for repayment over a period of up to 6 years. I think that's right, and CBILS up to 10 years in some cases, and then there's obviously the new recovery loan schemes. So there is a lot of credit in the system still. So I think we should avoid a flood of insolvencies. However, I mean, given the economic picture, I think that there will be an increase. I mean, effectively, the economy has been frozen in time over the last year, and so there will be insolvencies that would have occurred in any event, even without the pandemic, and that these will have to work through the system now when things start to get moving. And in addition, and as Victoria was mentioning, in the context of property, habits have changed and will continue to change. Working habits, shopping habits, and we're going to see significant changes in the high street. So this will result in a shake-up that's going to cause more insolvencies and the restructuring of businesses, but equally new opportunities as well.
Well, that's very helpful. And Ollie, we're getting more questions for you, so I'm going to come back to you if I may. But I'm anxious to get Alex in at this point. Alex Dawson, who's a solicitor who's just joined us here at DMH Stallard, and Alex and I actually met as opponents in a particular case, and now he works with me on my team. I'm very glad to have him. He's experienced in complex issues relating to shareholders and directors' duties, professional negligence, all sorts of consumer and business credit arrangements, regulated and unregulated lending activity with security issues, loan agreements, commercial fraud, and he's currently, as well as working at DMH Stallard, busy lad, currently a visiting lecturer at the University of Westminster, focusing on company and partnership law. So without further ado, I'm going to hand over to Alex. And Alex, we're already getting questions for you, so I will hand over to you now.
Thank you, Johnny. Thanks for the introduction. Thank you, Ollie, for your contribution. And thank you, Victoria, for your contribution also. And many thanks to the marketing team for putting together the slides and invitations. You can see we have a number of participants. I'm going to briefly discuss directors' duties, and then I will sum up with enforcement of monetary judgments, and that will be me, and I'll answer any questions that Johnny has posed. Next slide, please, Amber. As a company is a separate legal entity, directors have decisions to make on behalf of the company. Importantly, directors have a fiduciary relationship with the company, which is a relationship of good faith, and as they are agents of the company, they have the ability to bind the company to transactions. The relevant duties are set out in sections 171 to 179, and whilst there are a number of duties, I will draw your attention just briefly to section 172, which is the duty to exercise reasonable care and skill. Sorry, to promoting the success of the company is section 172, and the duty to exercise reasonable care and skill is section 174, because we've been seeing a number of these recently in our practice. If a director breaches his or her duties, they may be disqualified, and an order prohibiting them from being directors can be imposed. Disqualification orders and their penalties can range in duration, dependent on the seriousness of the allegation. We've seen some that are ranging between 5 to 15 years. And just as an example of a 5-year penalty, these can include reckless or negligent conduct on the company's behalf. And some examples of more serious offences which fall into that 15-year disqualification can be fraudulent trading or criminal behaviour. Next slide, please, Amber. Just going to, as I've just discussed directors' duties, I'm now going to focus the remainder of the lecture on enforcing a money judgment. A starting point to note is that obtaining a monetary judgment is the first step in getting what you are entitled to or what you are seeking as a creditor. What I mean by that is a court will not automatically enforce any judgment, and the onus is on you, the creditor, to facilitate enforcement action. Just a few more introductory points would be, when can you start enforcing? So does the debtor have an opportunity to pay before enforcement methods can be undertaken? Sometimes judgments will have 14 days before enforcement proceedings can be instigated. How long do you get to enforce your judgment? There are limitation issues to worry about. I'm not going to cover them in this short time, but there are limitation issues to worry about which you should be aware of. Whether you have more than one enforcement method available to use, so a combination of the methods I'm going to discuss. And finally, it's important to consider the effect of insolvency and how that can affect any enforcement method. Next slide, please. Taking control of goods. Taking control of goods is a popular enforcement method as it can be done very quickly. It requires the court to issue a document either in the High Court or County Court, and an enforcement agent or bailiff, as they're commonly known, will take control of the goods and sell the debtor's goods to raise money. Obviously, this method depends on the debtor having sufficient goods of value to satisfy that judgment. Typically, it's a more affordable method of enforcement, although a High Court enforcement agent will charge more than a County Court enforcement agent, and there are also time limits because a High Court enforcement agent is usually quicker than a County Court bailiff. As I said, this is a popular method of enforcement because ultimately individuals, creditors, businesses ideally don't want bailiffs or enforcement agents turning up at their business premises or residential premises seeking goods. Next slide, please, Amber. A charging order. As the name suggests, it charges an interest of the debtors. There are a number of interests that can be charged, and I've set them out on the board for you to have a look at, but these do include land, so property, securities, so shareholdings, dividends in respect of those shares, funds in court, interest in a trust. Typically, it is a slow method of enforcement, and in reality, there can be 3 stages, which will include the interim application for a charging order, a final charging order, and any subsequent order for sale. charging orders are an effective method of enforcement where there is substantial equity in the property or in the shareholding, and the debtor is the sole owner. Although I add the caveat that you don't need to, the debtor can be a joint owner of the property and you still can make an application for a charging order. These are very effective methods of enforcement. Well, this is a very effective method of enforcement as it affects debtors in their personal and professional capacity. The cases I've been involved with have all settled or the debt's been paid prior to a final order for sale. And I'd just like to briefly mention insolvency and charging orders. And as a final point, if the debtor is involved in any insolvency proceeding, so bankruptcy against an individual or winding up against a company, this can affect the method, this can affect your ability to enforce charging orders. If you have the benefit of a charging order before the bankruptcy or insolvency proceedings take place, you should be able to enforce your charging order. If, however, the insolvency or bankruptcy proceedings have been undertaken prior to you obtaining a final charging order, and I say final charging order instead of interim charging order, this can pause your charging order proceedings and your enforcement proceedings. So it's very important, it's critical, in fact, to check whether there are any enforcement proceedings being undertaken against the individual or the company who owes the debt. Next slide, please, Amber. The final slide I will discuss is a third-party debt order and attachment of earnings. I will only briefly touch upon these for completeness because they are not the most common methods of enforcement used. But a third-party debt order allows a creditor to take money that is owed to them directly from whoever has the money. Usually it is the debtor's bank or building society holding that money. As I've just mentioned, this is not the most common method of enforcement as it requires details of the debtor's bank details, their beneficiary account numbers, and things like that. An order for an attachment of earnings involves a creditor taking money directly from the debtor's wages or salary. Please note that this cannot be used against individuals who are self-employed. And again, this is not the most popular method of enforcement as it requires details of employment. I say that, but these can be used alongside other enforcement methods, and you can use these alongside charging orders or taking control of goods. And that concludes my presentation. And Johnny said he had some questions for me.
Yes, indeed. If I may come in at that point. In your experience, which enforcement method has proved the most successful?
I would say charging orders and taking control of goods for the reasons I've mentioned. Taking control of goods, or having a county court bailiff or sheriff turn up at your property is a very unpleasant experience. And not that it's happened to me, but it is a very unpleasant experience, I can imagine. And and charging orders, as I said, can charge beneficial interest. And whilst it takes longer, it is a very effective method. So those two enforcement methods, I would say. And
one question, as a landlord and having difficulties in terms of forfeiting my tenant's commercial lease, what options does this leave me? And I'm looking at PGs and eventually suing and seeking judgment.
So I've seen this quite a bit at DMH, and we're acting for a number of clients who can't forfeit commercial premises, and they are having to call on personal guarantees and sue the guarantors of those, the guarantors, whether they're individuals or companies, or threaten proceedings. And ultimately try and then get a judgment and then go through an enforcement procedure.
And finally, my company has a judgment against a partnership. What method of enforcement do you suggest? The questioner doesn't specify whether it's a limited liability partnership or a partnership law under the Partnership Act. But I pass that over to you in any event, Alex.
Okay. If it's a general partnership, again, I would, especially now the restrictions are hopefully beginning to lift, if it's a general partnership, I would advise that bailiff or taking control of goods, because again, if you've got offices opening, it is an unpleasant experience, and it's quick and it's cost effective. I would also add that, again, I would introduce a charging order to that, because you can charge partnership. Again, you'd have to check what assets the partnership has, but again, these can be charged and potentially realized if needs be. But the threat of those two alone is a powerful weapon to be able to use.
Okay, well, there's just a final one in the closing minutes for Ollie, in fact. Ollie, wave at me, you're still there.
I am, hello.
Okay. I'm owed money by a company which was in a moratorium but goes into liquidation. What priority do I get pre-moratorium as opposed to post-moratorium debts? So I think broadly, it's if a company which was in a moratorium goes into liquidation, what priority, if any, would the moratorium debts have over the pre-moratorium debts? I think I've got that right. Apologies to the questioner if I haven't.
So, well, yes, they continue to have their priority. So the priority debts that I listed, which were payments for goods and services supplied during the moratorium, fees, expenses of the monitor, rent during the moratorium period, wages and salary, and financial services debts. These are all the sort of priority debts. They will continue to have a priority over other preferential debts and debts secured by floating charges. They will have priority over those in any subsequent administration or liquidation that the company goes into.
Okay, well, I think that's bringing us up to the hour. I'd like to thank all the panelists and indeed all of you for participating. And on that note, without any being attacked by any pets or without any deliveries having been made, I will say cheerio to one and all.